Josh brings the numbers, making dreams grow. First-time buyers stepping through the door. Keys to your castle, they're what we're here for. Navigating through the home buyer's maze. Educated steps in a world full of haze. The podcast is rolling with wisdom to share, helping you settle in your new land. Navigating through the home buyer's maze. Educated steps in a world full of haze. The podcast is rolling with wisdom to share, helping you settle in your new lair. Jeb and Josh, they're paving the way. Dreams to reality, they make it day. From the first hello to the closing sign, your journey to home is looking divine. The numbers make sense. Jeb shows the vision beyond the white fence. Teamwork like this is rare to find, helping you leave all your doubts behind. They talk about homes and talk about life, cutting through the stress and the buyer's strife. With every word they light up the spark, guiding you through when the road feels dark. Jeb and Josh, they're paving the way. Dreams to reality, they make it day. From the first hello to the closing sign, your journey to home is looking divine.
Happy Wednesday. Welcome to another week of the Educated Homebuyer Live with Mr. Josh Lewis and myself here to update you on the economy, answer your mortgage and real estate questions, have some fun while we're doing it. Josh, what's the big change from last week to this week?
Well, since we have the 4th of July. It is Huntington Beach's national holiday. It's the Smith family national holiday. We got to spend some time with the Smiths. We need to get some video of you getting all of the moms and wives in their 4th of July clothes going down this giant slip and slide that you have in your backyard. That was most impressive. I think it was the kids. The peer pressure from the kids got them all to do it, but it was a good 4th.
There you go. So happy to be with you guys once again. Tonight, we're going to talk about the housing market shifting a little bit more in favor of buyers. We're going to take a look at charts, as we always do, kind of update you on inventory, everything that's happening out there in that world. But while we're doing that, it's always helpful if you guys start putting questions in the chat now. That way, when we're done, we can just flow right into it and make the most of the hour that we have here. For those of you maybe joining us for the first time, this is something we do every single Wednesday at 5 p.m. Pacific Standard Time. Sometimes we're a little bit early. Never late, Josh. Never late. Only early, but this is about 4 years in the making here. So we've answered a lot of questions and hope to continue doing that with you guys. So with that, Mr. Lewis, shall we dive into some charts and see what's happening in the world of real estate? So big news this week is active inventory jumped quite a bit, and it's now sitting at 853,000 homes, which is up 31% from where we were last year. And now we're basically at the low levels that we saw back in 2019. So kind of, depending on where we're headed over the next couple of months or what happens over the next couple of months, inventory is likely to continue growing, at least for the next couple of weeks, where we are at the moment with rates and that sort of thing. So let's take a look at Orange County and Huntington Beach. So Orange County sitting at 4,882 listings. I didn't move the charts to the back so you could actually see the percentages. So it was basically up less than 1% for Orange County inventory. I think last week we were at like 4860 something. This week Huntington Beach sitting at 281. It was actually down a little bit this week, just over 1%. Last week I think we were like 286 or 287, somewhere in that ballpark. So inventory, pretty stable for the most part, not seeing big increases in either direction.
OC Jeb was up 0.43 and Huntington Beach was down 1.78, just so you have the numbers.
There you go. there you go. And you can, we can't do it on the fly. We have to re-import the charts, but active inventory, this is something I like to look at. This just shows, where we are today versus where we were back in 2019 with regard to inventory. So anything that's a brownish color basically still shows the inventory is down. If it's white, it's pretty neutral, and any sort of green means inventory's grown since that 2019 level. It's actually higher now than it was back in 2019. So you can see the concentration here. Much of the Midwest, the Northeast is still brown, still below those 2019 levels. But you got Texas, Florida, some parts of I don't even know what state that is, Josh. That would be like Nebraska, somewhere in that ballpark. Mexico.
I didn't know what you were looking at. I was going
maybe
to throw out Kentucky. I was going with Kentucky.
Kentucky. But anyhow, that gives us an idea of what's happening. And then there's another look at a similar chart. So this, again, shows the shift from 2019 to 2025, but just puts it in actual numerical perspective. And you can see which states are still performing the worst. I mean, the inventory hasn't increased versus what is back to those pre-pandemic levels and giving buyers a lot more options out there in the market. So I think at the moment, Josh, if I read it correctly today, I think there's 10 states that are back above 2019 levels as a whole. I think that came through from Resi Club. So where most of the U.S. is still
see
below.
them there. It's those green states right through. You got 1, 2, 3, 4, 5, 6, 7, 8 right there.
Yeah, you got one at 0. I don't know if they're counting that one. Oregon's at 0. So once you factor in some of those, you're pretty neutral for some of those states. So 10, 12, 13, somewhere in there, pretty close to where they were. National single family new listings. I never say national on that, so I was confused there. So down a little bit week over week, which is not really what you want to see, but a lot of it has to do with the holiday. But the idea is that the peak in new listings are here and that they should continue declining from this point forward. But we'll see next week when we get a more regular week with regard to data because of the holidays actually playing into those numbers. And weekly pending sales over last week actually down again, 66,967 compared to last year, just over 67,000. Again, holiday week, all of that stuff plays into that data. It's not really something that, worry about, pay attention to at this time, just because of where those holidays fall week-wise compared to, say, a year ago. Now, when we look at total pending sales, 396 this year versus 381 last year, basically just showing year over year growth. Again, the idea is to just pay attention to what happens over the next couple of weeks as things normalize without the holidays in there. Properties with price reduction sitting at 40.6%. So we saw a small uptick from last week. Now, this is something we often talk about, Josh, and I like to throw this chart in there just to give people an idea of delinquency rates. This is on first mortgages, and the average there going back to what is that, Josh?
2004 on the left.
2004 was at 4.13%, the average, whereas right now we're sitting at 3.2%. We saw a small tick down in the latest reports there, but again, delinquencies still sitting there really, really low levels. Share of the 100 largest markets seeing annual home price decline. So about 30% of the largest markets out there have some sort of price decline, Josh. The only reason I brought this chart in here is basically to show you, compared to what a bubble in the housing market looks like to where we are now. Completely different. And even a price decline at this level is, a decline could be 1%. We're not talking big numbers by any means. And then the spread, we've been talking about this, spread again, staying pretty much where it's been, but I think it's sitting at 2.37% this week compared to, which was a small decline from where we've been over the last week or so.
It should compress if and when we get a decrease in interest rates. There's still definitely some concern among MBS investors as to what happens if we ever get a drop in rates. So we're elevated and they're not paying premiums. So you're having a little blowout there in the spread.
And this chart here is something I just found interesting, so I threw it in here. Just share of county population born in the current state of residence. So basically, the darker blue is these people were born in these areas and still live there. So you can kind of see where those areas are. Much of the Midwest, leading into South and kind of the Northeast there. Whereas, you look on the western part of the state, it's a lot less. Still a good percentage of the people were born there, still live there, but not nearly as much as the central part of the United States there. Good news, Josh. Fannie and Freddie now are allowing Vantage scores versus the FICO score. We're going to do an actual podcast on this in detail to tell people what this means, in a lot more detail with the actual people from Vantage. But what does it mean in a shorter version?
This is far and away the biggest news of probably the year in mortgages, but in mortgage and real estate, it's big. So we don't know the timing. It's supposed to be sometime within the next year. The current FHFA director is expediting this, wants it to happen sooner rather than later. And you go, great. So we have a different credit score model. Why does this matter? A lot of times you guys do credit monitoring with Credit Karma, some of these other tools, and you're like, why is your score so much lower than mine? It's the difference between a Vantage score and a credit score with FICO. The lower the score is, the bigger the discrepancy. So we're hoping in the next 12 months this gets rolled out. The sooner the better, because we did an interview with back in 2022, I think, with the folks at VantageScore, and at that time they said 37 million more Americans, like 10% of Americans who currently have no credit score, will have a score under Vantage that don't have a score. And despite what Dave Ramsey says, very, very hard to get a mortgage without a credit score. At a minimum, you're going down to manual underwriting and having a much tighter underwriting process. So of those 37 million people who will now have a score, a third of them are mortgage ready, 620 plus credit scores. You got 9 million more Americans that can qualify and get an automated underwrite. The biggest thing with that, it's a big win for underserved communities. People of color disproportionately have lower credit scores or are more likely to not have scores. So by pulling them in, they also are more likely to have alternative credit. This takes into account rent, utility bills, other things that will give you a score and give you a higher score. So some groups of people who are less likely to use credit are more likely now to have scores and have better scores. So all of those things really, really important, and we'll get more details and bring those details to you as they come about. Jeb, you the next slide here, you can see you had the slide here previously about delinquency rates. We get a lot of questions about, well, hey, with student loan repayment restarting, isn't that going to cause grief and trouble for homeowners? And won't we see some people default on their mortgages? So this gives you an idea. Less than 30% of FHA borrowers have student loans, less than 20% of VA borrowers. The GSEs, so Fannie and Freddie, a little over 15%, portfolio loans, a little over 15%. So less than 20% of borrowers even have student loans. So we don't know what percentage of student loan borrowers are going to be struggling, but less than 20% are impacted. So this will show you percentage of borrowers who are currently past due on their mortgage payments. So FHA, it's about 9%. For all borrowers, it's a little bit over 10% for those with student loans. VA, it's under 4%, a little over 4% for those with student loans. Fannie and Freddie loans, 1% default rate, still under 2% for those with student loans. So overall, defaults are 2.5%, and it jumps up to about 4.5%. So is there an impact there? Absolutely is an impact. Some people with large student loans who just thought about or bought into the idea that they were never going to have to repay them are going to have issues with that. So I don't think this makes a widespread difference in home prices, but it's important. Jeb, we are going to be doing, we did record it today, so we will go live in the next 10 days or so with an episode of the podcast on buy downs, temporary buy downs, permanent buy downs, how to allocate concessions from sellers, whether it's a builder or a reseller. But this shows you prior to 2007, basically they weren't being used at all, or 2022. 2022 July. Prior to that, when rates spiked, there was almost no buy downs being done. 2-1 buy down, 1-0 buy down, 3-2-1. And they had gone up as high as 5.5% of loans and about 3.5% right now. So still, the vast majority of borrowers are not resorting to buy downs, which I think is the right decision, but they do have a time and a place. And we have that coming up here in the next 10 days or so on the podcast. You guys always ask who's able to buy, who's doing this in this market. So the average debt to income ratio, if we go back to the middle of 2021, it was at under 38%. And now with rates higher, home prices higher, we're over 40%. So we've seen about a 2-3% increase on the average back end DTI. So definitely everyone is feeling that stress. So what are we having? We're having people that are able to accept a higher debt to income ratio. And we've also seen from 2019, credit scores were down around 725. Up now in 2025, we're up 740-ish. So better credit score, better credit qualified borrowers accepting a higher debt to income ratio. So talk about the economic news we had in the last week. Last week, Jeb, was an abbreviated week, so it should have been on Friday. Thursday, we got non-farm payrolls. They were expecting about 130. We got 147. We'd had a weak ADP jobs report on Wednesday. Market did not like this. Bonds absolutely sold off there. We saw a drop down in the unemployment rate. When you see this isn't really a big deal, other than being vultures in the mortgage industry, and those of you who want a mortgage, want lower interest rates, it would be beneficial to see this tick higher. Until it ticks higher, we're not likely to see rates go appreciably lower, and we're seeing this kind of move sideways, and it actually ticked down 0.1%. Wanted to show that with rates down over the last 6 weeks, before they jumped up an eighth to a quarter over the last week, we were down 3/8 to 0.5% over the last 6 weeks. This shows you going back to 2021, we had a lot of mortgage applications. The mortgage purchase index was very, very high. We saw a steady slide all the way down till the start of 2024, where they just kind of went sideways at a very low level. As rates have dropped here in 2025, still elevated, still above what people want to see them at, we have seen purchase applications increase, and we had those released today, a 10% increase week over week when rates had hit the lowest level. There is pent-up demand out there. When people see rates come down, see a more manageable debt to income ratio, people do want to step in. So looking forward, next week, Jeb, we have CPI. Truflation tracks this pretty closely. It tracks it well in advance. There's a high correlation over the long haul, but a big dip a week over week from 2.03 to 1.66%. If we were to see some of that picked up in next week's CPI report, you could see an improvement in interest rates. With Fed funds, we are now, after the jobs report last week, seeing a 93% chance that they do nothing in July, which is kind of what we've always expected, but market's kind of coming to accept it. Still no change over the rest of the year, expecting 2 cuts, a September cut and a December cut for 50 basis points. Jeb, we had a very, very high performing video on the podcast this week. Trump is wrong about mortgage interest rates. And what we're talking about is he came out a few weeks ago saying Powell's an idiot, and he called him, was it a moron? Well, he used very not nice words for Powell, said he should be dropping rates 2 to 3%. So we go through and say, cool, if they did that, if Powell woke up tomorrow and said, Trump is right, I am dumb, I need to drop rates 2.5%, what would it mean for mortgage rates? So about 25-minute episode giving you the full breakthrough. It's had a lot of views. People have enjoyed that. So if you haven't seen it, go out to the podcast, The Educated Homebuyer on YouTube, and check that out. I think it's a valuable video.
Yeah. And, for those of you who are waiting for interest rates to come down, waiting for the right opportunity, you can go to jebsmith.net/rate watch and fill out your information. And if and when rates come down, we can reach out to you so that you don't have to monitor them every single day like Josh and I do. You can just stay updated and or just stay patient, and we'll update you that
is the key part.
But I did want to start and say thank you, guys. We hit 7,000 subs on the Educated Homebuyer channel, so we appreciate that. We appreciate you guys showing up and supporting that channel, and Josh and I's vision of educating and helping create more home buyers out there that actually understand the process and know what they're getting into and how to go through the process. A lot of you guys call and give feedback and repeat what we've said, and to be completely honest, a lot easier to work with than the average home buyer out there, just because you guys are actually doing your homework and know what's going on. So we appreciate you. So, just wanted to say thank you for that. And if you haven't subscribed, please consider doing it. So, Josh, we don't have a lot of questions at the moment. We've got a lot of comments on my beard so far. We've got, two comments on my beard. Chris, probably the biggest supporter of the beard.
Of the beard. Definitely the biggest supporter of the
maybe
beard.
the show, but the beard. And so, I'm doing a hike in October, Josh. I told my wife I'm not going to shave until after the hike. And then she was like, there's no way you can do that.
Oh, come on.
I think she's probably right, but we'll see. We'll see.
I say get the pants back and do what you want.
Dude, I mean, she said go for it. I said I don't know if I could. So I don't know who has the pants. I have the pants. I just don't know if I could put them on. Juliet, same thing. But what do we got here? We got Makai. Makai says, how are student loans calculated into debt to income ratio? Do you
go by your actual payment if you're on a plan, or is it calculated based on the loan amount? What if your payments are deferred? The loan amount has absolutely nothing to do with it. If you're deferred or in forbearance and it shows a zero, so if it shows a zero on your credit report, it can be deferred, it can be in forbearance, you can be in an IBR, an income-based repayment plan with a true $0 monthly repayment. Some loan programs will accept a zero IBR, but we do have to document it. We do have to get your documentation from the servicer that shows it's 0%. So depending on the loan program, they're going to count if you're in deferred or in forbearance. So we've got a zero payment. They're going to take the loan balance and you're going to take either 0.5% or 1%, depending on you're looking at Freddie and FHA will take 0.5%. Fannie will require 1%. VA is kind of the most reasonable out of all of them. It's 5% a year. So 5% divided by 12, it's like 0.0433 on the monthly. So they're going to come up with a pseudo payment for you. So your best case, if you're deferred or in forbearance, is to get into repayment, get an IBR payment, preferably a zero, so you don't have that increase. The thing that I always tell people is make sure we have a plan, make sure we're being strategic with this. If you're not in an industry where you're going to be eligible for public servant loan forgiveness, kicking the can further down the line just makes it worse and worse and worse for you. You want to get into repayment at some point that's going to make those things go away. And preferably you are in some type of PSLF that you would be eligible for forgiveness at some point.
All right. Thanks for that. And I believe we've actually done an episode on student loans on the podcast too, in some detail. So if you have questions there, you can head over to the podcast and check that out. Should give you a little bit more guidance on that. At the moment, there's 40 plus of you watching and very few questions out there. So if you're not interested in asking a question, how about letting us know where you're located across the United States? Whoa, Josh.
I'm yelling your voice at you. I was trying to find for Makai, I was trying to find the correct episode there to give him the link.
Heather's in Inglewood. We got Pop Keys stopping in as well. Thank you guys for being here every week and supporting the show. If you guys don't ask questions, Josh and I don't know what to talk about because we talk so often. We don't even hang out anymore because we see each other so much in the office. We used to hang out outside of the office. Now there's nothing to even talk.
Well,
so we
used to hang out, and then Jeb had 3 kids. So he's at football, soccer, the library, open house.
Library.
Well, one of your children is studious. The other 2 we'll see.
We still, I mean, the library possibly with his mom, but Jeb doesn't go to the library. I don't go to the library, bro.
You're excluded
I don't even have a library
from library activities. I like
library
it.
Card. Cleburne and Little Rock. We got Ali in New Jersey. Makai's in Tampa. So we've got the part of the East Coast covered there.
We have a lot of listeners in Tampa. We are able to help 2, 3, 4 buyers every year in that Tampa area from the show.
Good stuff. And we got a buyer in the Houston area, actually, that's put in an offer. Josh, did she get her offer accepted? Do we know?
I do not know. Need to follow up on that. And it may be a couple of days because something we haven't dealt with in a long time. The offer that she's making is on a home that is a short sale. So we don't just have the buyer or the seller accepting the offer. It then gets accepted and then it cruises on to the lender to accept the offer.
So let's talk about that for a second. We don't have a lot of questions. Let's go over what a short sale is. So in theory, a short sale happens when somebody's looking to sell their property and they owe more on it than it's actually worth. They don't have enough equity to either cover the compensation or the payoff. After everything's out, they don't have enough to cover the balance on the loan, and therefore they have to sell it basically at a loss. But in order to do that, you've got to get the lender's approval, and the servicer has to agree to it and say, yes, we're allowing you to sell this home for X. Now, back in the day, how these worked is it was pretty cumbersome. I mean, it took weeks, months to get a short sale approved. There was a lot of paperwork involved. You as a homeowner had to submit pay stubs and documentation, just kind of showing a hardship and not being able to make up the difference in all of these other things that happened at the time. It's been so long, Josh, since I've done a short sale. I don't even know what the process looks like today. So I don't know if it's any simpler. I have to believe it is. I just don't know by how much it is, and how quickly you get an answer.
Everything's better and more tech savvy than it was. So we're talking in 2007, 2008. The last time you saw a wave of these was almost 20 years ago. So not that mortgage servicers are on the bleeding edge of tech, but I used to remember they would say, it would give you a list of documentation that was like triple what you would need to qualify for a mortgage, and they wanted you to fax it in. And then magically they never got your fax.
It was
43 times. They would never receive it, or we got it, we didn't get everything we needed. So should be a secure portal now where you're uploading and you can see what's uploaded and you can prove that it was uploaded. But you have to show a hardship. They're not just going to go, hey, you know what? This house sucks. I want out of here and I don't want to pay you back what you owe me. And at that point, what the bank has to do is make a decision. They're not necessarily accepting a short sale or approving a short sale to help you as the seller out. They're looking for a win-win. You're saying, hey, I was eligible for this loan. I qualified for this loan. I intended to pay for this loan. I can no longer afford it. And the bank has to go, okay, you can't make the payment and you don't want to live there. So you're not asking us for a modification to find a way for you to live there. What is the way that we minimize our loss? And if you have $200,000 of equity in the house, they're probably going to look at it. And you're not asking for a short sale, but they're going to look at it and go, fine, you don't want a modification. You don't want to pay us. We're going to foreclose, and that's the most money to us. In this situation, there's no equity there. So they have to say, how do we mitigate our loss? What is the cheapest way out of this? In this instance, it's a $250,000 house. So we're not talking a $800,000 or $900,000 loan. The loss severity is fairly minimal. On a percentage basis, it will be large. I don't think they owe a ton more. This isn't an area where the home price dipped a lot. It was someone bought when prices were a tiny bit higher in that part of Texas, and they put very little down, and then they were behind on the mortgage. So with arrearages, penalties, all that. But in essence, what happens is you make the offer. The seller goes, this is great to me. I want to get out of here. And then at that point, they and their realtor have to present that to the lender. The lender has to approve it and determine that, yes, this is the most we're going to be able to get out of this.
There you go. And then we had a follow-up question on it. Mike asked, can you get an FHA loan on a short sale? Yeah, you can do any type of financing on a short sale. The sale process doesn't dictate what type of loan you can get on a property in that case. Like even a foreclosure, one of those properties, assuming the property's financeable, condition-wise, in any sort of financing is fine in those conditions. So you should be good to go. All right. Josh, we've got a couple things here. I'm trying to see if
we got Mean Boy 69 checking in from Puerto Rico.
We got Rue in Virginia. We've got some new names coming in here, some new areas that I'm seeing. So good stuff. All right. Let's see. There was one here, Josh, that Anna Bear says, how do you have no cost refinancing? Is it just rolled into the new loan? That is one option, but
it's not a no-cost loan at that point. If you're paying the cost and rolling it into the loan, it's no out-of-pocket, but it's not a no-cost loan. So if we're talking a true no-cost loan, Jeb's gone through this before. He's done it a couple times on his current home just since buying a year and a half, 2 years ago. You are accepting a slightly higher interest rate, and the lender says, hey, we're going to make more in interest over the life of this loan. We will give you a credit at closing, and that can cover some or all of your closing costs. So a no-cost loan is basically taking a slightly higher interest rate to get enough money from the lender to cover your closing costs. On a refinance, we can negotiate the closing costs down with title and escrow, much lower than it would be on a purchase. So the bigger your loan, the smaller a credit that you need, or so a smaller increase in the interest rate to get you that same credit to cover the cost. But if you're rolling it into the loan, if someone tells you they're rolling it into the loan, they're telling you there's no out-of-pocket costs. They're not telling you there's no costs.
Good stuff. Makai followed up with a question on someone suggested looking into rent-to-own home purchase. How does that work, and why would anyone do it? So a rent-to-own purchases are typically not seen in appreciating markets because there would be no benefit to the seller, or there would be less benefit to the seller in those scenarios. Rent-to-owns are great in sideways moving markets and declining markets because it allows the seller to essentially sell the home at today's price and get paid at some point in the future for whatever that price is agreed upon. Now, how it typically works is there's an agreement with the seller in what you expect to pay for the home, but every single month you make your rent payment, you're in theory paying more than that rent payment. So say your rent payment's $3,500 a month. Maybe the agreement is you pay $5,000 a month, and that $1,500 that you're paying in addition gets set aside to go towards the down payment so that you can end up buying that rent-to-own property. So it's a little difficult to explain and go over in great detail in kind of a limited time. I've done a video on it where you can kind of walk through it, but they're not as easy to come by. And typically, when does it work for a buyer, I think is the more important question. It works for a buyer when you're trying to lock in a property that you like and you think that the property could be worth more in the future, or you're in a position where you're trying to get your credit or something else in order so that you can finance that property at some point later on. But rent-to-owns are, I don't know, they're far and few between, at least in my experience. Josh, any?
It's everything that you said is correct, but when you're in a market where they're prevalent, largely, many times they're used by investors to sell a property that they're having a difficult time selling. And they're also designed to set the buyer up to fail, because what they do is say, hey, this property would rent for $2,000. We're going to charge you $2,500 a month. In 12 months, that excess $500, we're going to set it aside. You'll have $6,000 for your down payment and closing costs. And what happens is people default, they move, they don't exercise their option to purchase, and they got to rent a property for $2,500 a month instead of $2,000 a month.
Yeah, and there's usually a time frame on it that, hey, it's you have to purchase it by this date. At which point you don't, then you risk losing whatever you've paid into it. So it benefits the seller more than it does the buyer in those scenarios. What do we have here, Josh? Got anything?
In Puerto Rico, Mean Boy 69 has a question. He's trying to buy a home with Fannie Mae, but they keep canceling my offer. The realtor says that they don't want to go lower than ask, but the area is not the price that they ask. What can I do? Maybe, and then we didn't finish the thought there. So if you're still here, Mean Boy, jump in and finish that thought so we know exactly what we're looking at. But if you're trying to buy a home with Fannie Mae, I don't think you're saying you're getting Fannie Mae financing. It may be a bank-owned Fannie Mae property that you're trying to purchase, and they don't want to go that low. And they're like any other seller. They have an idea. I mean, Jeb, you have perspective on this. You sold hundreds of homes that were bank owned by Fannie or Freddie back in the day. What does that look like? What happens if the property is just sitting and they're not accepting offers?
Yeah, and I don't even know that that's what he's saying. I mean, it could be, hey, I'm getting a loan with Fannie Mae and I'm putting in offers and the seller's not accepting it. But let's just answer your question. Basically what happens is, that when the bank puts a property on the market that's a foreclosure, when they put it on the market, they've done some sort of market research, right? And so that typically means an agent has gone out and given their opinion of the value of that home. In some cases, multiple brokers have given their opinion of the value of that home. Now, that doesn't necessarily mean that's where the bank prices it at, right? We give them an idea. Sometimes they go higher than that, depending on what they're trying to accomplish. But what I will tell you is banks aren't in the business of owning real estate or holding on to real estate. So if it's in a market that where it is priced high and days on the market are adding up, there's a high likelihood that they're going to adjust that price closer to market value as time goes on. but it has to be something that's supported by comps, right? They don't just lower the price because they're getting offers lower than the purchase price. There has to be something there to support it. So hopefully that provides you a little bit of insight. Now, if it's, a seller, not a bank, not willing to negotiate, similar thing for the most part. Maybe it's just the seller that has their expectations are incorrect. They think their home is worth more because of X, Y, or Z. And so it's, again, having a realistic seller is not always realistic. And so there's got to be some data provided there to be able to help support your decision. But at the end of the day, that only works if the seller's willing to do that. So, but if you have more clarification, put it in there. We can discuss it further.
Jeb,
All right. Yep.
I'm not even going to try this person's name, but this is a good question for you. Is it true that at the end of the year, you can get more incentives? I want to buy in Jacksonville, Florida. Should I wait until the end of this year? And I'm thinking we're probably talking about new construction because we're saying incentives. We're not talking seller concessions. Sure. But from that perspective, on the builder side, how's that work?
I mean, potentially, right? I mean, there are fiscal year ends to these different companies out there. They're not always the end of the year, though, right? It depends on when their fiscal year end is. Maybe it's July or June or whatever. So you got to figure out what that is. But I mean, I would say that, the slower times of the year, like for Southern California, that time is, around the holiday season. That's typically the slower time of the year. And so I would say that there's better opportunities out there in those markets, because if a seller has a home on the market during that period of time, that shows they're a serious seller for the most part, because anybody that's willing to sell a home when there's holidays and families and all of that stuff, primarily talking about existing construction, that tells me that they're serious and probably needing to do something more so than somebody that says, hey, listen, I'm just going to pull it off and wait until the spring, until the market comes back. So I understand the logic behind it. I don't necessarily think that logic always works, but I do see that there could be opportunities just depending on what you're looking at. I would say talk to a local in that market and just try to see what, what's out there. But I think markets like Jacksonville, at least based on the data that I've seen, inventory has increased substantially. It continues to grow. It's a slower market. So the longer something sits, probably the better opportunity you have.
So Jeb, Paul Menendez has a good question here. Bought a house August of last year. I have 7%. Believe there will be an opportunity to refi into a low 5 soon. That would be aggressive if we got a low 5 soon. I hope you are correct. It would make my life much, much better. But in terms of saying for a refi, when should I contact a lender? 3 months out? Well, the question sort of implies that you know when rates are going to drop. The problem is you don't. Last year from July through September, we got 1.5%, a little bit more than 1.5% drop in rates, and it came and it went. A lot of people missed that window because they were waiting for it to get into the low 5s. If you have a 7% on a $400,000 or $500,000 loan, a rate of 6.25 would, with a no-cost loan, would make sense. So what we always say here is do this, just get on the rate watch. Jeb, how in the world, why will this thing not get off the screen? There we go. So if you get on the rate watch there, we've had people who've been on there for 7, 8, 9 months and nothing, because rates have not really dipped significantly since last fall when they started spiking back up in September. But with that, we have the rate watch list. We can reach out to you and let you know when rates get there. We can set a strike rate to say, okay, for you, you are not willing to do anything until rates get to 5.25. So it may be longer for you. It will be longer for you to get a phone call, but we can go through that. We can run the numbers and determine what does it really take to make it make sense. We have a buyer who came from the show 2 years ago. Just talked to them a couple days ago, and we set a strike rate. And now we know as soon as it hits that level, this is when we step in and do the refi.
All right, good stuff. Anna, Josh
I disappeared. I bounced. I'm out.
So Anna has a question, says, what would you do as an agent trying to help your client buy a home, but due to the location and budget cannot find a suitable property, shortening timeline to move to? Well, you really only have a couple of options. Your first option is to be patient and wait for something to pop up. Your second option is to broaden your horizons a little bit, open up your search criteria, add a couple more cities in that maybe you weren't first considering, and or you change your non-negotiables or some of the things you're looking in the property to add more opportunities to that list. If neither of those are something you want to do, the third option, and something that's definitely doable, is have your agent try to generate a potential opportunity in the areas that you're looking, right? If you know what neighborhood you're trying to buy in, there's a way of sending out letters, potentially door knocking, just doing some different things in order to try to generate business in those markets. And that's always an option. Not always effective, but it's an opportunity or a potential opportunity to add something else to the plate. But that's it. I mean, it's really about time. I mean, time will probably allow more opportunities to come there. But there's a high likelihood that because you're looking for something that's super specific, there's also somebody looking for that as well. So, that creates competition and the potential for, driving higher prices and that sort of thing. So I think the best option is probably trying to find something off market.
Jeb, as someone who represents sellers, Steve Park has a question. He's heard that cash buyers have about a $20,000 price advantage versus loan buyers on $1 million house. Do your sellers, are they willing to give up $20,000 if someone pays cash for the home instead of getting a loan?
No. In fact, I've had multiple cash offers recently on a couple of different properties where we also had loans, and all of them we accepted loans over a cash offer. Some of the cash offers were super aggressive, thinking they had some sort of
magic. It's magic money.
Like some, that it did something that the other money wouldn't do. But what I will say is cash doesn't, I mean, when does cash have an advantage? I think is the better question. Cash has an advantage when the seller needs a super quick close for some reason, and or there's a potential issue with maybe an appraisal where you're thinking there could be an appraisal issue. Outside of that, cash holds no advantage at all. It's the same money to the seller at the end of the day, right? They're not getting cash; they're getting a wire into their bank account.
Think about that, Jeb. What you just said is the most important thing. At the close of escrow, if you wire money into escrow and someone else gets a loan and their lender wires the money into escrow, the seller doesn't know the difference. The money gets wired into their account all the same.
Right. No, I mean, in fact, I've got a cash deal right now where it's a cash deal. Contingency has been released. We're supposed to close on Monday, and now we're not going to close on Monday. And it has nothing to do with the cash. It has to do with the buyers being out of the country and some other things here. So it's like, just because it's cash doesn't mean it's a smooth process and it makes the deal that much easier. You can also have issues and hiccups even with cash. So it's important as a real estate agent that you explain that, or are able to explain that to a potential seller, because in my conversation, like I've mentioned this many, many times, is one of the things I ask sellers is like, what's important to you in this process? I will tell you 9 times out of 10, it is putting the most money in my pocket, getting the highest price. That's the most important piece. So if you're cash and you're the highest price, congratulations. But if you're cash and thinking you get some sort of deal, then in most cases that's not going to work. So I think your theory is debunked, is what I'm saying.
Jeb,
Josh,
Mean Boy came back with some clarification, and he said the house is from Homepath, so it is a Fannie Mae bank-owned property. The realtor told them that it needs $25,000 to rehab, so I need to go FHA 2 or 3K. They're asking $280, but I'm offering $250 to add for the repairs, but they keep saying no. In your experience, Jeb, again, every market's different. Fannie may be doing different things now. They wouldn't bring a property to market that needed $25,000 of repairs. They would do the minimal repairs to make it financeable where a buyer could walk in and deal with it.
Well, we also have to remember that was 12 years ago, 13 years ago, right? When I was selling those. The last one I think I sold was in 2012, maybe 2011, somewhere in that ballpark. So back then we would rehab them, we would make them financeable. So there were no issues. So is the question, it needs $20 to $25,000 because cosmetically it sucks and it just needs that? Or is it in order to finance it, it needs $20,000 to $25,000, because that's two different things. And if Fannie Mae has the property, my guess is Fannie Mae will finance it. I've never seen a property that Fannie Mae has that they wouldn't finance themselves. So I don't know. I think there's probably some room in that price. I just can't tell you how much, but I would say just keep your eye on it. And the bank again isn't in the business of holding on to property, so at some point they'll understand and have to make an adjustment, or someone will buy it. One of the two. All right. Young has a question. Would I have a problem qualify for a mortgage as a W-2 tech contractor? I just left my tech job of 4 years for a contract to
contract to hire role that pays $20,000 more
hire
a year.
role.
So let's just think of it this way. Contract to hire equals temporary. You are a temp employee.
Oh, there you go.
So until you are permanent, you are most likely to have a problem. The only reason why I say most likely is if your contract to hire with the actual company and your pay stub just shows your role and your pay rate, many loans or many borrowers who have salary income, we don't need a verification of employment. But what I can say is 90% plus of the time when we see something like this, either the employer name, something on the pay stub is a giveaway that this is not a permanent position. So if the underwriter is aware that this is not a permanent salaried full-time position, you will need to wait until you have full-time income, because one of the things that an underwriter needs to determine is continuance of income. And a contract to hire position, we don't have a guarantee that you're going to be getting that job, because if you did have a guarantee, they would already make you full-time now.
All right, good stuff. Question here says, do you feel like it's more common now than it was 2 years ago to get the seller to pay for closing costs? We are saving 3% plus closing costs in the Central Valley. Yes, I do think it is way more common now for a seller to pay concessions than it was, hell, even 6 months ago. And I think as time goes on, that's probably going to increase as long as mortgage rates stay high. So this is what a more traditional market feels like, guys. That, prior to the pandemic, you could ask a seller to pay for some closing costs. You could ask them to give some credits, and it wasn't crazy. When the market flipped and sellers had all the control, that kind of went out the window. But now it's back, and it's something that we've seen pretty much my entire career. It hasn't been quite as common over the last couple of years.
Even Jeb, we were talking about that offer that we put in yesterday for the buyer in Texas. They went in 5 over asking for a $5,000 credit. You're like, it seems a little off for that market, but the price had just been cut $25,000. So we're like, it went way below all of it. Was priced near the comps and probably wasn't selling because it was a short sale. They went super low. We need the $5,000. We want the bank to approve that short sale. So I would say that's common. Most of my first-time buyers, depending on where you are in the country, that's $200,000, that's $400,000, that's $600,000. In Southern California, it might be $1 million. But those buyers, they're getting concessions because for most people, they're like you. Hey, I was able to save up my 3.5%, 5% down. Another $10,000, $20,000 of closing costs is tough. So we're getting that. And what I'm seeing is the buyers that are buying $1.5 to $2.5 million properties. In most instances, there's not a huge amount of demand for those folks because they generally have the money. It's a move-up buyer, or they've saved up a bunch of money. They're negotiating on price. So whether it's the seller giving some flexibility on price or concessions, I would say 70, 80% of the transactions that I'm seeing right now absolutely are getting that.
All right, good stuff. Question from Willing. Would a broken AC pass an appraisal or come back subject to? So I think it would pass an appraisal. I don't think ACs aren't mandatory in properties in order to live. They're nice to have. And especially if no one knew about it, it definitely wouldn't come back. But Josh, in any issue with a AC that doesn't function being an issue?
The only world that I could see it, let's say you're in a market like Phoenix where it's August and it's 120 degrees. Like you and I, it's easy to say, hey, that's not a health and safety issue. But when they have blackouts and stuff, you hear, especially for older people, I could see someone asking about it, but I don't think you would have an issue or a problem 9 times out of 10.
All right, guys, if we're providing any value at all, we answered your question. You show up here because you want to make fun of us. Either way, do us a favor, hit the like and subscribe if you haven't done so already. Help support the channel and keeps us motivated to enlighten you guys with real estate content. How's that? All right. Let's see. Mean Boy came back and said they don't want to repair it because of Trump's new orders. They're selling it as is here. So where are you located? Where was Mean Boy located?
Puerto Rico.
Puerto Rico. All right. I that seems crazy to me that they're basing it off of Trump's new orders, but let's we'll go with it. We'll go with your explanation there.
What the thing that I would say, whenever I hear things that just sound a little off, we would have to talk to your realtor. I mean, there are a lot of just shitty realtors out there that don't know what they're talking about, that will make up the craziest, lamest explanations. So a lot of what you've told us, again, I don't know, you may be dealing with the best realtor in Puerto Rico, but it was based off of, they say it's $25,000 to repair. We're not getting countered. We're not getting an offer accepted. And they're telling us it's because of Trump's orders. When I hear that, my crazy alarms are going off. So doesn't mean I'm right.
And Josh has crazy
but
alarms.
I would be wary that you are, it's like talking through a can, right? You're not talking to the seller. You're not talking to Fannie Mae. You're talking to your agent, and you are relying on the fact that they're getting you accurate information. And I'm telling you, there's some things there that sound a little off.
All right. Cesar has a question for you, Josh. And in fact, we answered this question in next week's episode that comes out on Monday, where we talk about red flags in the housing market. In fact, Josh and I don't necessarily agree on where home prices are going. So Josh, the question is, do you think home prices will go down? And maybe we shouldn't even answer the question because, again, we don't agree on this. We did an entire episode on it. Comes out Monday. I would say, Caesar, check the episode on Monday, the podcast, and listen to it. We have a difference.
Just because
neither of us think the housing market's going to crash, but we do have a difference in opinion on where prices are going. And
it's a 20-minute explanation versus us buzzing through in 2 or 3 minutes. It would be short and pithy, and you would be like, thanks, I don't really feel enlightened. But 20 minutes, we can enlighten you.
There you go. All right. All world construction. I'm in the construction field, and I'm wondering if the big, beautiful bill will help me make more money, especially with immigration situation out here in Southern California. What do you guys think? So is it going to help you make more money? So in construction world, what do you need to make more money? You need people wanting to do construction. In my experience, I will tell you, I am surprised every time I go out with how much construction is being done all the time. Like every house has something going on. So it seems like you guys are all doing fairly well in general, but like what fuels construction? Lower rates, right? People, more expendable income, people having, money to throw around. So interest rates staying higher impacts you a little bit more so on that side. But if interest rates could come down, that could allow people to do cash out refinances, do a couple of different things to free up some cash for buildable and construction and that sort of thing. But when it comes to the big, beautiful bill, Josh, there's nothing directly related in there that I think personally, I mean, I may be missing something here that benefits you so much on that side, outside of some of the tax benefits that you could get as a potential self-employed business owner.
We've talked about this before, like with the immigration situation. What were we saying? People were saying, well, home prices are going to go through the roof because all these homes are getting built by illegal aliens. And you're like, really? I don't think big national builders are taking those types of risks, and they're not letting their subcontractors take that risk. But we have talked about it, that for us here in Southern California, many of the skilled contractors are undocumented. So from that standpoint, many of them aren't taking jobs. Yeah, I mean, this sounds dumb to compare this because it's not exactly the same thing, but you got some odd jobs at your house. You can't go to Home Depot anymore. Those dudes are like, I ain't hanging out at Home Depot.
Dude, we ICE comes to Home Depot. My wife went to Home Depot yesterday. She said there were no people in the parking lot,
which is shocking. Like in 15, 20 years, like you need some work done around your house. You need help. I can't do it myself. We would roll down to Home Depot, get as many guys as you'd need. And sometimes it's just pure brute force labor. Some of those guys actually knew. You would have to talk about it. But all I'm saying is, definitely harder. So do I think the local kitchen and bath renovator, who he's here documented and is a citizen or here legally, could he have a couple of guys that he knows and trusts that are really good that work on it? Absolutely. So the demand for those services is low because of the things that Jeb was talking about: low disposable income, the economy's not doing great, rates are high, people aren't doing cash out refinances to pay for a new kitchen or bath. But if there's less of those people doing the jobs, it could be great for you from that perspective. I don't know that anything in this budget bill is short-term positive for real estate, mortgage, contracting. But in your situation, if there's less competition, less skilled labor, the cost for that labor goes up.
Agreed. Mike, does short sell take longer to close due to both parties having to make a deal? And the answer is typically yes. Yeah. I mean, I bought the house that I bought in 2012. That particular property took about 6 months to get the short sale done. Depends on where that person is in the process. Typically, you can't start the short sale process till you have a qualified buyer willing to make an offer. That's when the process kind of really starts, and then it kind of goes through the channel. So it's probably not 6 months today, but I would guarantee you it's more than 30. I just don't know what that time frame looks like. All right.
Let's just go back and briefly touch on this, Jeb. So Paul Menendez, I'm hoping for low fives by the end of the year. So let's just say, is it impossible? It's not impossible, but let's say what would have to happen? We're at 6.875, 6.75 for the best qualified borrowers right now today. So to go down 1.5%, the lowest that we've hit is about 5.75. So high fives since mid 2022 in the last 3 years. So we would have to have the lowest rates in over 3 years. You would have to have a 10-year treasury under 3%. We've hit massive hard resistance every time it's hit 3.6. We have to go all the way to 3%, and you would have to have the margins compressed, which Jeb showed the chart of the margins at the top of the show. Margin between 10-year treasury and a 30-year fixed would have to get down to about 2.25. So you'd have to see margin compression there of 0.25%, and you'd have to have a 140 basis point drop in the 10-year. It is highly unlikely, not impossible. You would have to see a serious weakening in the economy to see continued decreases in inflation. We saw that Trueflation is telling us that inflation is still trending down despite the tariffs. Positive for interest rates, good for your hope for a lower interest rate. But we also looked at last week's jobs data. We're not seeing an increase in unemployment, a decrease in jobs. And last week on the show, we showed the chart that shows what is the replacement level for jobs. How many jobs do we need to create each month for unemployment to stay level, to not get worse, to not go down? And it's only, according to some people's educated calculations, like 86,000 jobs. We created 140 last month. So without both of those things happen, inflation moderating and the jobs market getting worse, you are not going to see rates in the low fives. Could it happen? It could, but both of those things are going to happen to see it.
There you go. Jay Castle says, where do loan officers pull credit rates, credit reports, basically, saying that he's between 610 and 660 with 3 bureaus, but they're telling him he's closer to 580. So Josh, you're using a FICO model that is basically pulled through the mortgage world. It's FICO, but we talked at the top of the show that Vantage is going to be coming out here within the next probably 12 months or so, which could help on that front. But I don't know. How do you want to answer that?
So for a mortgage, you have to pull all 3 bureaus: TransUnion, Equifax, Experian. Each one of them has slightly different information about you, which is why they have different scores. They each use a very, very similar FICO model on the data that they have in their record. When you say I have between 610 and 660, it tells me you're using Credit Karma, one of these other models, and they are using VantageScores. VantageScores skew higher, and the lower your credit score, the more it skews high. So if people are pulling it and it's 580, it's 580. So that 610, 620 on Credit Karma is worthless. If you're looking at your credit card and it says, hey, your score is a 622, and it'll say VantageScore on there. If you want to track, if you want to monitor at home, to my knowledge, myfico.com is the only one that will give you the actual mortgage models, and they're like $40 a month. So it's more expensive than the others because that data is more expensive for them to get, and they will actually give you the models that you're going to be seeing when you go talk to someone like me.
Yeah, I would say save your money. You don't need to see that. Just, talk to somebody, have them run your
How
credit
in the
report.
world are you just say, hey, get in your car and drive, hope you get where you're going? If you're not monitoring it, you don't have any hope of getting where you're going.
Get your credit report, figure out what you need to work on it, and then have it pulled at some point. I don't know.
The people that are capable of doing that, Jeb, don't have 580 credit scores.
Well, they probably don't have $40 a month either.
Well, if you don't have $40, why are we trying to buy a house?
Well, that's fair. So I don't know. I would, yeah, I don't know. I see people spend a lot of money on credit reporting and keeping up to date on that sort of thing. And I don't know. I don't see the value in it, maybe because my credit's not bad, but anyhow, just me. It's that time, Josh. It's that time to answer another question, and I don't really see one.
Victor has a comment here, so let's just throw Victor's comment up, and we'll end it on this one unless someone comes up. Well, of course, someone follows with a good question after that. But Victor says, I know older people complain that they used to pay 10 to 15% interest back in the day, but I feel like homes were nowhere near the price of today's homes. Homes are 2 to 3 times more expensive today. In real terms, 100%. They're actually like 10 to 15 times more expensive. If you say the median priced home in 1982, when rates were 18%, was like $80,000. The medians for, I guess he's right. I was thinking California prices, 400,000. So it's five times more expensive. But if you look at affordability today is very similar to where it was in 1982. The biggest difference is we could come down from 18% interest rates fairly quickly and easily. 6% to 4% doesn't increase affordability a ton. And for all the reasons we've talked about a million times here on the show, unlikely to see a major correction in home prices from where they're at due to the nested equity that everyone has and the ultra low interest rates.
Yeah. I mean, another reason, right? We talk about how did home prices get so much ahead of where they were. Wages have increased. Like there's different things, inflation, there are different things that are factored in there as well. It's not just home prices increasing that much and affordability just skyrocketing. There's things that play into that affordability piece, and interest rates can help it. But home prices aren't likely to move substantially. I saw a chart, Josh. I wish I'd always saved it, and I see it occasionally and I never do it. And it always talks about where prices would need to go, rates would need to go, and wages would need to go in order to get back to the affordability levels that we saw in like 21. And it's just like the numbers are crazy. It's like, home prices would need to drop by 50%. Interest rates would need to drop by 4%. It's like crazy. Anyhow, there's one more question here that I'd like to answer here. And I've been talking a lot about it recently. And that's, what is an assumable mortgage? So an assumable mortgage is a mortgage that the bank has said that someone else can take over. FHA allows assumable mortgages. VA allows assumable mortgages. Some adjustable rates have assumable mortgages, but primarily FHA and VA. And what it does is it says, hey, listen, if you can qualify for this mortgage, then you can essentially take it over. The problem is you've got to come up with the difference between the balance of what that person owes on the home currently and the list price of that property. An example, I have a property in Aliso Viejo. The list price on that home is $1,035,000. The seller has a $550,000 VA assumable mortgage. So if at 2.75%, by the way, payments like $2,400 a month. If you wanted to assume that property, that mortgage, and take it over, you could, assuming you qualified. But here's the caveat. You would need to bring in $485,000 in cash and keep the first mortgage, or you would have to get a second mortgage behind that first mortgage. And Carrington, the servicer on the first, says, hey, listen, we will allow you to do a second, but you've got to have at least 20% down of your own funds. So now you got a 550 first.
I don't know that the servicer can layer on guidelines like that.
That's according to them, that's what they've said. And
FHA has a servicing handbook,
just and that like came from ChatGPT.
I would love to look at it. Here's a flip side, Jeb. I got a crazy one. Freddie, longtime listener to the show here, that helped during COVID. One of the best success stories we've ever had. He's going to be getting married. They're looking to buy a bigger home together to start their family. And he reaches out last week. He goes, hey, what do you know about assumable loans? We're looking at this house. We really like it. It has an FHA loan that can be assumed. And I look at it and I'm like, it's $789,000. They're asking like $850. They were putting 20% down anyway. So it worked because they're going to put 20% down. I look at it. There's FHA at 5.75%. And I'm like, that's not really beneficial for you. Like once you factor in the mortgage insurance, the conventional loan you're getting is a very similar interest rate. So to jump through the hoops of getting approved and delay and drag this out. So it was interesting. I haven't seen a whole lot of people bragging about their assumable 5.75, but from their perspective, they're like, well, it's lower than the current rates. And someone could possibly have that size of a down payment.
Sure. No, they're great opportunities when it's the property that you wanted and you have the money to make up the balance, because it makes sense. If you have to get a second mortgage, once you start doing a blended rate because of where the rate would be on that second mortgage, it's not nearly as enticing as it was when you were just looking at that 2.75%. So with that said, guys, I hope you found some value tonight. If you haven't done so already, make sure you hit the like and subscribe. Go check out the episode we did on Trump not understanding mortgage rates. It's on the Educated Homebuyer channel. But until next week, make sure you buy right, borrow smart, and build wealth. Adios.
Amigos.